I had a fascinating interview with Tobias Adrian at the IMF on financial stability, and he expressed some concerns not only about perhaps some weaker bank balance sheets in some parts of the world, primarily not in the developed world, and he also expressed some concerns that markets have been running ahead of the economic reality. To what extent do you think there is a risk to the recovery from problems in the financial sector?
Not too much. I think there's extraordinary central bank support for the financial system broadly, and I think that applies to the large banks in each market as well. Banks have come into this crisis with very strong capital positions, and liquidity certainly is not a problem given the central bank actions, but also the actions that all of us have taken to shore up our liquidity for just an event like this. So I think the financial system is really in very good shape. And as we've seen, at least so far, and you've seen a number of U.S. banks report in the last couple of days, there's been a material tapering off in the credit impairments, which of course this is following a period of a real spike in impairments. But it says to me that at least for those banks that have reported, they were in front of the loan losses that are likely to come. Material though they are, they're manageable. They've been absorbed, and now it's time to move on. So I don't think that the banking system itself poses much of a risk to the recovery.
There is a fear among some that even as we looked at some of those earnings, Bill, and we saw that even in the consumer banking area, they weren't terrible numbers. There is a concern among some, though, that we are waiting for another shoe to drop in terms of the full impact of continued loss of jobs and concerns about ability to meet debt obligations, whether that be credit card debt or mortgage debt. Are you in that camp, or do you take a more positive view?
Well, we heard the comments from Fed Chairman Powell about the need for stimulus to sustain the recovery in the U.S., and I'm sure that was a very clear statement, very deliberate, and obviously targeted at a deadlocked Congress in the U.S. But I think that's the case across the board. I mean, we're clearly getting into a phase of, we could call it a second wave or an extension of the first wave, or whatever you want to call it. I'm sure we'd rather not call it anything. That will require some element of ongoing fiscal support if we're going to avoid something of a cliff effect in terms of job losses and the consequent impact on consumption. So I think governments do have an opportunity or an obligation, or it would be helpful. I mean, you can characterize it how you'd like, to carry on through this next phase of this pandemic. But it may not happen, and it may not happen for some understandable reasons. I mean, some countries feel fiscally very stretched, even despite the fact that we've got very, very low interest rates. That doesn't seem to be the conventional wisdom, or the wisdom in any of the major economies, though, where I think we can expect some government support to persist. And against that backdrop, I think the underlying momentum for recovery can continue to grow.